Goedemiddag, good afternoon. Welcome to this PensioenPro Partner webinar. My name is Manno van den Berg. I present this webinar, which is sponsored by BMO Global Asset Management. Today, the topic will be ESG and emerging market debt. This seems a challenging combination, but it's also a very promising one, as will become clear in this webinar. Well, at least we hope so. We will address the opportunities of investing in EMD and how ESG is not a hindrance, but indeed can add to the opportunities, can help be a driver for return, and can help to limit the risk. But of course, this is not only about risk and return. Many institutional investors, Dutch pension funds in the lead, are convinced that they also have to play a role in creating a better, more sustainable world. That means investing in change. And you can do that to invest in emerging markets. Change that is much needed there. For institutional investors, it's increasingly important to have an ESG framework for all of their asset classes. This is due to legislation, of course, but also due to changing investor demand. Before I introduce our speakers to you, I would like to invite you to ask questions. You can do this through our chat function, and you can do them in Dutch or English, it doesn't matter. We might also ask you your opinion in some multiple choice questions. Also, you can use the chat function then, and you will see a pop-up of a vote button then. Back to ESG and EMD. We will address this interesting combination together with two experts. Valentina Chen, Director Co-Head Emerging Market Debt, and Juan Salazar, Director Responsible Investment, both from BMO Global Asset Management. So Valentina and Juan, I hope you're on the line. Thank you for joining us today.
Hi, thank you for having us.
Hi both. So maybe a good kickoff for you, Valentina, to start. So what's your opinion about the ongoing trend of ESG in the investment sector? What do you see as biggest challenge, and what do you see as the biggest opportunity?
Thank you. So first, let me start by challenges. I think ESG itself can mean different things, right? From climate changes to fight against the poverty or death penalty. And then more importantly, when it comes to ESG investment, it can take on many different forms. And I really like to think about it as a spectrum, because some people might approach it in a traditional sense, therefore not so much ESG is considered, or now we can take it into the form of ESG aware process or exclusions, or we give higher weights to asset classes where ESG scores are higher, or impact funds where specific ESG goals are targeted, like carbon reduction, and all the way to very charitable strategies where it is really doing the right thing for the greater good, where on the other hand, they're giving up some or all of the return. So I think the challenge is very, very important to be thoughtful to understand what ESG means for different institutions and how we go about it. But the great opportunity is when it comes to ESG, you can do the right thing by incorporating ESG into investment, and it also does not hurt your return. So this is what we say when it comes to ESG investment, you can have your cake and eat it.
Okay, thank you. Well, the same question for you, Juan. The biggest challenge, the biggest opportunity. Juan?
Hi, good morning. I'm sorry, I was having technical issues. I couldn't hear anything. But now can you hear me now then?
Okay, good. So let me repeat a question then. What do you think about the ongoing ESG trend in the sector, and what do you see as the biggest challenge and the biggest opportunity?
Yes, thank you. Thank you, Manon, and thank you, everyone. For us, the biggest challenge is data. The availability of ESG emerging market sovereign data is questionable, if I could say that. The data is often old, it's backward looking, and it's most of the times missing a lot of values. So, the thing here is that we're focusing on momentum, and many indicators that we're using are only available with a lag of 1 or 2 years, which might prevent them for reflecting, for example, changes in governments or corruption scandals that could potentially affect institutional quality. And from an opportunity perspective, for us, the most exciting one is the role that investors can play in influencing policy making across emerging markets to support sustainable development, for example, in line with the achievement of the SDGs. And this could be something like, supporting more coverage and better quality of primary education, ensuring access to clean water to all people, and so forth.
Okay,
Thanks.
great. Yeah, that really seem good calls of the United Nations. A question for you, Valentina. We all know that institutional investors are on a global search for yield. Why is emerging market debt such an interesting asset class for them?
Well, let me start with the yield aspect of emerging market. So, for example, if we look at the emerging market hard currency, overall currently offers a yield around 5%, with the high yield component offering more than 7% and the IG offering more than 3%. So EMD definitely offers very attractive yields. But furthermore, emerging market also offers very beneficial diversification effect because it covers around almost 80 countries. And when you think about economic importance, depending the data source, but the emerging market currently generate about 50 to 70% of the world GDP. And it's not only that, because by the trade linkage, right? If you hold the developed market portfolios, they still have emerging market risks. So therefore, I would say not only emerging market is an interesting asset class, it's simply an asset class as an investor you cannot afford to ignore.
Okay, well, that sounds really great. But at the same time, we are seeing that many institutional investors are a little bit cautious, underweight in this segment. And the reason they give is that, it's considered to be rather volatile and risky. Is there some truth in that?
There is some. I think one has to be very precise here, because within emerging market fixed income, there are different sub-asset classes within there. For example, hard currency debt, local currency debt, corporate debt. If you focus on emerging market hard currency debt, actually it gives you very good risk reward measured by Sharpe ratio. So it generates, if you look at the past 10 years, it gives you an annualized return of about 8% with 10% standard deviation. So it actually gives you equity-like return with the fixed income-like volatility. But when it comes to local currency, perhaps because of the FX foreign currency component, it can be more volatile. But on the other hand, local currency debt generally has a much lower rate of default because typically only better institutions can afford or can issue local currency debt. And when we think about ESG investing in emerging market, a lot of the risk is headline risk, which is political risk. So that's on the G component of ESG. So therefore, it is very, very important to incorporate the ESG analysis into country analysis, and because they drive, to a large extent, they drive a large component of the spreads and the returns. So therefore, this is why at the BMO GAM, we have been doing ESG into our sovereign analysis for more than a decade.
Okay, so thanks. I hear you say hard currency and also look at country risks. That's very important. We also asked the audience a multiple choice question. Don't worry, you already filled this in, but we ask you the question, emerging market debt has grown into an important asset class. Still, many investors are underweight. What's, in your opinion, the main reason So maybe we can have a look at the results of this interesting question. Okay, so the first question, the risks and volatility are quite high. 24% of people voted that. Number 2, transparency is not as well as in developed markets. 51, by far the most popular answer. Only 7% talked about strict internal portfolio guidelines on ESG, and 18% didn't see really a reason to be underweight at all. So more than half states that transparency is a big problem. Maybe one of you can react on this quite clear message: transparency.
And maybe I can start first. I think certainly if you compare emerging market to developed market, that can be the case. But I would say the first thing is you are compensated by the risk you are taking, right? So one of the reasons that the EM gives you higher yield is because it has this higher risk. Therefore, you are somewhat compensated. And the second thing is, I think from an emerging market sovereign issuer perspective, it's in their interest, right, to improve transparency, to improve institutional soundness, because by doing this, then they can, the interest on charge will be lower. So we do see, in terms of quality, there's many sovereign countries are working to improve the transparency of the asset class.
Okay. Sorry, Juan, do you have anything to add that transparency is seen as a big problem?
Just briefly to follow up on what Valentina said, yes, we have been seeing more and more emerging markets tackling the transparency gap issue. They understand how important that is for foreign investors, and it's a long process. It's going to take some time. But later on during the webinar, when we speak about engagement, we'll talk about how that's an area of focus for us.
Okay. You just pointed, Valentina, to the future just in your previous answer. But maybe what do you think of the development of EMD in the coming, let's say 5 years? What do you think will be the most important trends investors have to look at?
Shall I start again? So the first thing I would say is, as we've discussed before, in terms of economic importance, it is a very important asset class, but nevertheless, it is strategically underallocated. So I do focus that we will see a trend. More and more asset managers will have to allocate more into emerging market fixed income as a strategic decision, as a core asset class to hold. The second thing is the asset class itself is evolving, right? For example, for the past 5 to 10 years, we've seen large issuers from GCC or the Middle East countries coming into the market to play and actually improve the overall quality of the emerging market hard currency class dramatically. And on the other hand, we also see more and more issuers from frontier markets, typically Sub-Saharan Africa. So we do see more and more countries coming into the EM fixed income space. And then I think the most important thing is ESG in emerging market fixed income. I think this will be a long journey, and no doubt it will continue to evolve and enforcing positive changes to this asset class.
Okay, thanks. So it seems like this is an asset class almost too good to miss. Many opportunities there, also changes, but also development. So thank you for your insights there. It's time to put the other ingredient in the mix, ESG. We'll be coming to you then, Juan. It seems to be a rather challenging combination, as I said earlier. Why, in your point of view, does this combination makes good sense, and what do you expect for the future?
Thank you. So the combination makes absolute sense because it basically allows you to have a better grasp of the risks that you're facing when investing in EM sovereign debt. in the end, this is critical to enhance your ability to generate returns over the long terms. Our expertise in ESG, as Valentina mentioned, spans more than a decade. And, now more than ever, we are absolutely convinced that this has served to strengthen our analytical and investment processes and outcomes. In terms of the future, we all know that emerging markets are going to be disproportionately impacted by issues such as climate change, demographic growth, pollution, socioeconomic inequality. So, to the extent that investors can be more critical and more sophisticated in trying to identify the risks, that's where we're going to see a lot of effort and a lot of investment going into. And in addition to that, we expect the continued emergence and consolidation of sustainability-linked or themed sovereign bonds, for example, green bonds, social bonds, SDG bonds.
Okay, can you explain why you see a continued emergence? Can you draw the line towards the future? What makes you so sure that this is a growing asset class, this is a growing concept?
It's because these sustainability themed or linked bonds offer a clearer opportunity or possibility for investors that are looking to allocate their money to specific issues or specific themes to do that, actually. So, to the extent that we have seen little things popping here and there, but the market is still very sort of young, if you will. But to the extent that the demand is there, we are seeing more and more actors in the investment industry come up with solutions, and sorry, not the investment industry, the sovereigns come up with bonds and products that might be attractive for investors to put their money in.
Okay. Well, the magic question is when you put ESG in your portfolio, what does it do with your risk-return profile? There's many research on that. What can you tell us about that?
It makes it better, absolutely. Our own research, as well as research from other established industry players, clearly show that the ESG-informed investing does not come at the expense of returns. In fact, it can help deliver more sustainable returns over the long terms, as I was mentioning before. And for emerging market debt, the case is especially compelling. Not only does research show that ESG scores are significant drivers of sovereign spreads, but we're talking a broader economic and moral case to this too. When we consider ESG issues in investments, we know that it makes financial sense, but it is also, from our perspective, the right thing to do.
Okay. Maybe in short, can you tell us something about your ESG model you use?
Sure.
Because I understand it's rather typical. It's not a mainstream one.
Yeah. So we've built up a model that covers over 90 countries from the emerging markets universe. And what we do is use a number of indicators across the E, S, and G spectrums. And that this includes data from the World Bank, the Transparency International, Freedom Press, and some environmental perceptions indices that from renowned universities. What we do is then assign a score to each indicator, and these scores are then aggregated to result in a single country ESG score. Our model is not based on exclusions. We focus on assessing momentum and on engagement. This is what underpins our approach, and we believe that this allows our PMs to identify mispricing opportunities. The focus on momentum is sort of a critical starting point for us, and I'll let Valentina talk about this later on.
Okay. Yeah, good. Let's discuss that later, because first I have another question for Valentina, and that's the one. Country scores really play an important role in your investment process. Why it's so important to understand country fundamentals when you invest in emerging markets?
Thank you. Yes, so a deep understanding of country fundamentals can discover attractive and mispriced security that leads to sustainable and consistent outperformance over time. And a very big part of our country score involves the ESG considerations, because I've mentioned before, ESG really drives a large part of the spread movement of emerging market hard currency. So the way we look at ESG is we first do our in-depth scan to identify countries that have low ESG scores or have negative momentum. Now we zoom in to these countries or credits to really understand why that is the case. And then we assess the valuation on top of it. Basically, is the risk or is the return on offer compensates for the ESG risk we are taking. And the next step would be portfolio constructions. Once we made our view, now we decide whether we should exclude these countries because the return is not compensated for the risk we are taking, or because of guidelines, or we reduce portfolio holdings aligned with our ESG score. But that's not the end. And then we continue to monitor the ESG involvement, like Juan said, the momentum, right? So it is really not a score currently as it is today. It is about the future, about the journey. And I think I want to say one thing about a negative momentum of a ESG score, because I think once you detect a negative momentum in ESG or country fundamentals, of course, that is worrying. However, it is very important to notice that once a country, I guess, has suffered from economic dislocations and the political or governance factors, but then if they work with multilateral institutions, IMF, to put a structural reform in place, then this gives us a better chance, right, for it to involve in structural changes, as well as an opportunity to capture positive return potential in the future. So we have to be very thoughtful when we approach this, the country fundamental analysis. It's all about the momentum and the future and the potential.
Okay. Thank you for your answer. I think it's time to have one of our multiple choice questions for you, the audience. So it's time for you to fill in some forms there. You can do this in your chat function in the vote button. I will read the question. ESG and EMD, it's a combination. Is it a combination you would consider? You can choose 1, 2, 3, or 4. I hope you can see them in your screen. Yes, we have to. Is 1, our whole portfolio has to comply with ESG criteria. 2, yes, but only if it doesn't hurt returns. 3, a very interesting combination indeed. 4, at the moment, no. So you can fill it in, and later on we're going to have a look at the results. Meanwhile, I have a question from the audience. I think it's for you, Valentina. Somebody has been looking into your forward-looking expectations for EMD on the long term, 15 years. And the question is, you lowered your expectations for the coming 15 years on the return. Is this true? I don't know. I cannot check it, but you can. And if it's true, why did you do that?
Sorry, let me make sure I understand. So is it the financial return forecasting for the next 15 years?
Yes, for forward-looking expectation, lower expectations on the long term, 15 years. As for hard currency as well as local currency. Is this something you can answer or not? Then when we have to move along, that's okay also. Because you didn't prepare for this question, I think.
No, I just okay. So I wasn't aware of the forecasting, but I can comment on that, right? I think from an asset class return theory, it is understandable as the emerging market countries do better or emerge, and then typically you would expect the return to also diminish because of the economic convergence, right? So this is the convergence theory. So we could say some of the gains are behind us, and as emerging markets develop and emerge, have better institutional strength, and then the return on offer also decreases over the long term.
Okay. Thank you for your answer. I hope the one who asked a question is satisfied with this. I am, so we just go along. Another question for you, Valentina, is that a problem many investors have with ESG is that it leads to exclusions, and that limits, of course, investment choices. How do you manage that?
And again, like I said before, there's not one way when it comes to ESG investing. And then also it really depends on the exact portfolio construction. So for example, a typical ESG benchmark is the JP Morgan ESG benchmark actually excludes about 20% of the emerging market sovereign universe. And often investors are quite comfortable with this by excluding only 20%. And it also actually reduces the idiosyncratic tail risk. And also the most important thing is once we do ESG exclusion, we notice that it is not just the lower sovereign rating countries are excluded. Actually, by ESG factors, the exclusion covers across different rating basket. Therefore, by ESG sovereign exclusion, you are not tilting or biasing your portfolio quality in a certain way. And then the third thing is if an investor is really worried about the diversification effect as a result of exclusion of sovereign, again, portfolio construction can help. We can introduce corporate bonds or quasi-sovereign debt into the portfolio. And typically there are many first-class companies out there with global operational footprints where the sovereign might be excluded for ESG reasons. So actually by adding corporates and the quasi-sovereigns, this can improve diversification, but also can improve the credit quality of the overall portfolio as well.
Okay, thank you. Maybe it's time to look at the results of our multiple choice question. Yes, we have them. Good. ESG and EMD combination, you would consider 47%. Yes, we have to. Our whole portfolio has to comply with ESG criteria. 21, yes, but only if it doesn't hurt returns. 26, yes, it's a very interesting combination. 6% at the moment, no. So that seems like a majority really consider this, a huge majority. Yeah, and they want to have their whole portfolio in line with ESG criteria. So, Juan, what do you think of it?
It's encouraging to know that the take up of ESG in emerging market debt is that high, whether it comes from a place of regulatory standards or whether a place of fundamental belief in this. But regardless of that, it's clear that it's ESG in emerging market debt, as it has been the case with other asset classes over the past 2 decades, is I want to call it mainstream at this point.
Okay. Valentina, do you have a reaction on the results?
No, I agree, but I would say, there's number again. I would quote a number. So if we compare the JP Morgan plain vanilla index return for the past 10 years versus JP Morgan ESG emerging market hard currency return, and you actually for the past 10 years, actually the ESG return on an annualized basis delivered higher return, so 23 basis points higher than the non-ESG. So we do have data based on the past 10 years to show that no, doing ESG does not hurt returns.
Okay, great. I also have a question for Juan, a question out of the audience just now. And it's about the country of Belize. just issued some government bonds, which one of the criteria was environment. So this is just an example about how government bonds in emerging markets adapt to sustainability. Do you think, Juan, investors can play a role there? Can they play a pushing role? Can they stimulate this, and how?
Yeah, of course, I think so. And as I briefly mentioned before, engagement is one of the starting points for us when investing in emerging market sovereign debt. We in how to do this, we believe in leveraging existing communication channels and opportunities. For example, traditional issuer roadshows where countries come and try to sell their bonds to stimulate conversations around ESG topics. So, going back to the first question that we asked the audience about transparency, that's how we usually frame our engagement. It's around ESG disclosure and transparency, pointing out which ESG information we deem important for our analysis and encouraging more of that data and of a higher quality. That's important. Beyond that, and this is going back to the Belize example, is that we seek to pursue engagement to call for structural improvements that are addressing material E, S, and G issues. There's been historically a clear focus on G, as Valentina was mentioning earlier, and G is critically important. Having said that, over the past few years and going forward, I think that there's going to be a much more focus on environmental and social issues. And as part of our engagement approach, we want to push governments to make progress towards existing policy commitments, such as the SDGs, as I said before, or the Paris Agreement.
Okay, thank you. Valentina, you talked a lot about momentum. Can you state, but very briefly, please, because otherwise we may be running out of time. What do you think are the advantages to focus on momentum? You can just mention one.
And I think it's very, very important to point out that emerging market sovereign inherently, by being emerging market, have lower ESG scores. So therefore, it is very problematic if you're just focusing on the low scores. So what matters really importantly is the progress, right? So we focus on progress in ESG practices and the performance to identify trends, maybe sometimes the market missing. So in this way, I think both in terms of asset class performance, it increases your return potential, but also focusing on momentum is doing the right thing by not unjustifiably punishing emerging market by low scores, but instead helping them emerge by providing funding so that they can embark on structural reforms.
Okay, thank you. Juan, you talked about engagement. I had a question prepared for you, but maybe we can just zoom in on the question how you engage with sovereign issuers on ESG. How do you do that?
So yes, there are two main ways that we've been doing that over the past few years. The first one is using existing communication channels that these governments have put in place. For example, the issuer roadshows that I was talking about. But we also do it through investor letters. For example, we have helped draft and signed letters to governments worldwide to ask them to raise their climate and biodiversity ambitions, for example, to implement meaningful policies to address those. So yeah, those would be the two main avenues that we use at the moment.
Okay, great. Thank you. Okay, we're going to another topic of this webinar. This is the EU Sustainable Financial Disclosure Regulation, SFDR, as it's called. It's aimed at increasing transparency on sustainability in markets and in investments. It's an important topic in the Netherlands, so it's a good topic for a multiple choice question. So be prepared. You can vote in your button in the chat function. The question is, SFDR has changed how we look at ESG in our portfolios. SFDR has changed how we look at ESG in our portfolios. I won't be reading the answers now. Please look at your screen and make a choice 1, 2, 3, or 5. And while you're doing that, I want to go back to Juan and ask him the following question. What are your main takeaways on SFDR?
Sure. So the key objective of SFDR, as most of us would know at this point, is introduce common standards for sustainability disclosure and reporting for investors. This objective supports two important considerations in our view. First, it makes it harder for investors to greenwash their products. In other words, it's going to be very difficult to brand a product with an ESG or sustainable label without being transparent about how that was achieved. Secondly, it provides investors, like end investors, with an improved ability to compare investment options in terms of the degree to which ESG factors are a consideration when it comes to the investment decision-making process. At BMO, we have been very careful in the implementation of SFDR when it comes to the Article 8 or 9, because we foresee significant challenges in supporting these choices. For example, there's a requirement to report on your principal adverse impacts. So we're working really hard to find a way in which we can do that. This in the context of the limited ESG data that we were talking about earlier today. So, overall, these are very exacting disclosure standards, and we want to be as sure as possible that we will be able to demonstrate that our products meet them.
Okay. Thank you very much. So maybe we can have a look at the multiple choice question we just posed to you. Maybe see the results, please. I'm waiting myself for the screen also, so. There they are. So, has changed the way how we look at ESG in our portfolio. 9%, yes, SFDR will have a huge impact on how we invest. 9%. 46%, we still don't know exactly how to deal with SFDR. 15%, no, we are already investing pretty much along these lines. 30%, no, it's just another one of the many regulations. So we still don't know exactly how to deal with SFDR, and no, it's just another one of many regulations. I think the first one is most important, don't you think, Valentina? That people still don't really know how to handle SFDR in their portfolios.
Yeah, I think. Yes, I can definitely sympathize that, and we've worked with our clients, for example, early on this year to change one portfolio from non-SFDR to completely Article 8. I think the importance here is there's no set rules, right? In the end, it is about disclosing that you are doing the right thing. There's no set rules or one way to do it. So no Article 8 funds needs to be the same. But often when it comes to emerging market fixed income, it probably will involve some degrees of exclusion. But I understand the complexity, or on the other hand, the freedom, because it is really about understanding the investment objectives and the ESG objectives, and come up with a tailor-made solution that is unique to the clients.
Yes, this is in essence also your advice, I think, to Dutch pension funds how they can prepare themselves for SFDR. I sense that it's really a tailor-made solution. And can you think of another thing you can help them with?
Like I said, right, it is. I can give some concrete examples. In the end, it is about taking a genuine and a systemic approach to ESG investing. So, for example, we work with one investors where they take a very strict approach to ESG investing or Article 8 approach, and as a result, a lot of the emerging market, the sovereign, are excluded. Therefore, we work with the clients to add back corporates and the quasi-sovereigns, where a different client still approaching SFDR Article 8, but take a slightly less strict approach depending on the criteria we're looking at. And in that way, we're more looking at basically positioning or adjusting weight of different countries based on the ESG scores. So again, I think I have to come back to the advice. I think the important thing is the spirit of the SFDR, and then we will have the expertise to work with individual clients to come up a specific portfolio that address ESG objectives and investment objectives.
Yes, yeah. You are just talking now specifically also about EMD, because there could be specific Article 8 challenges for EMD investors as well for this specific segment. Or were you talking about EMD already when you stated your opinion?
So, no, I think this applies to other asset classes as well. But the example I would be giving is on emerging market, especially if the approach, the starting point is emerging market sovereign.
Okay, great. Thank you for your answer. So, Valentin, we started this seminar by me asking you what's your biggest challenge, and we talked a lot about it already. But how can pension funds face this challenge best?
So a couple of things, right? The first thing is being very thoughtful about it, be very clear about, like I said, investment objectives and ESG objectives, right? There's no set rule, there's no right answer. So we need to take time to work out what ESG factors are the most important for individual or for institution, and how should we go about it. So I would say set out the outline is very important. The second thing, when it comes to emerging market, I think it is that balance, because we want to do ESG investing to make sure the correct funding, like basically the countries with better ESG scores get rewarded. But when it comes to emerging market countries, it's very important to focus on the momentum. So we give emerging market countries a chance to emerge by helping them, by giving them funding, by focusing on the changes. And the last thing I would say, this is really, it's a journey. It's a journey. We should be genuine about it, but also be very open-minded about it, because just allow room to evolve, right? Because whatever we said on day one, we will continue to work together to come up with the right proposal, the right portfolio constructions. So it is not something we have to decide on day one and set in stone. It is a whole journey.
Okay, you mentioned momentum in your answer, investing in change. From an ESG perspective, that's a very good thing. Do you think it also holds an advantage in a financial way to invest in change?
I think that's it. I mentioned it briefly earlier, right? So our process, when we look at the country fundamentals, when we look at country ESGs, so our opportunities to analyze this versus what the market is missing. So sometimes if market just focuses on headlines and also focus on the way it is today, then that is our financial or return opportunities, right? Because the market is missing the changes, and by being forward-looking and by positioning portfolio this way, it also enhance portfolio returns.
Okay, thank you for your answer. Juan, I ask you the same question at the beginning also. The main challenge you see in investing in EMD through an ESG angle. So and we talked about data, that's the biggest problem. So maybe we can look at solutions now.
From our point of view, tackling this data challenge comes down to building sufficiently strong analytical frameworks that can handle and interpret this data very carefully, and use it as a way of enhancing the process rather than as a way of just basically what I want to say is that this data is just a little piece of the puzzle. It's all about the qualitative inputs from experienced ESG and emerging market debt analysts that is going to be crucial in the end. And it's about sorting through this data with a critical eye, focusing on momentum again. You're trying to identify the trends, and in that way we can, still use it, but to our advantage rather than to our disadvantage. That from our own perspective, from externally, I think it is clear that data sources are improving by the minute. And this is not just for sovereign emerging market debt, but across all asset classes when it comes to ESG data. And again, the emergence of green, social, and SDG funds will further incentivize countries to develop ESG frameworks and reporting that it's going to improve data, transparency, and quality over time. But again, the message that I want to put forward is it's about our analytical capabilities to really sift through this data in a way that we can use it to our advantage.
Okay, thank you. I at the same time you started answering the question, I got a question from the audience, and it's related to your answer. So, by all means, let's use it. So, how do you assess momentum with data that are often outdated and backward-looking, or even missing? So, how do you do that?
I'll start, and Valentina can chip in if that's okay. This is about keeping communication within the team open at all times and doing it as often as possible, like, for example, through weekly, monthly, or quarterly country assessment meetings where, we sit down, look at what has happened in the past few years, what are our sort of expectations of what's going to happen. And, this is, complemented by our own research on what's happening in the countries, what's happening in terms of regulation and trends at an environmental, social, and governance levels. It's about complementing the existing data as much as we can with our own knowledge and our own experience.
Okay.
Is there anything you would like to add, Valentina?
I can add on that. So on the first, on the data side, so they are data providers, right? Cover across the emerging market universe. Then we can look at 1 year, 3 year, 5 years. So you're right in the sense that it is looking back, but nevertheless, that helps, right? It gives us some indication to compare the momentum, and also compare one country versus its own history, and versus other countries within the same region, and versus countries of similar sovereign rating. So it gives us some perspective. Then on the other hand, like Juan said, it is the qualitative analysis, and it is really about the willingness and ability for emerging market sovereign countries to involve positive change, whether that's a structural reform, whether the political system is supportive to improve education or healthcare. So we can incorporate that, right? So that is our daily job, to focus on country fundamental analysis to detect this trend, and then ultimately to assess the return on offer versus this momentum.
Okay, from the audience also another question. In SFDR, Valentina?
Yes.
Okay, in SFDR, risk control is very important. EMD is still seen as a little bit more risky than other asset classes. What's the biggest thing you can do to limit the risk? I know you've been talking a lot about risk control already, but what's the biggest takeaway you can give the one that asks this question?
Right. I think, again, I would come back. It is about fundamental analysis, right? It is about the medium long term, where the country is doing the right thing, whether it has the correct sound policy framework in place, right? Whether it is willingness to work with, for example, IMF. So we use our in-house 6 factors approach, so really cover fiscal aspect, current account, the external debt, growth, so everything versus what the market is missing. So we'll still bring back to diligent country research, and that is a very good way to anchor left tail risk. But nevertheless, like I said, because emerging market fixed income is perceived as very risky, therefore, there is a structural risk premium embedded in this class because people perceive it as risky. Therefore, the spread or the yield on offer is actually structurally higher than you actually realize the loss if you look at the history. So you are compensated very well versus the risk you are taking because it's perceived as very risky.
Okay. Well, we've come to the end of this webinar. I really like to thank you for your time. It was very nice talking to you, and I hope we're seeing you more. So maybe another time. I like the audience. I like to thank the audience as well. Also, thank you for tuning in again. Thank you for participating and asking some questions. And I hope you really got some new insights. We also have an evaluation form in now at the moment. You can see it, and you will help us if you fill it in, please. I wish you a good day. Stay healthy, and I hope to see you in our next Pension Pro Partner webinar. See you. Bye.